Okay, for this week's Forex in 5, briefly in G10. So, interesting developments in the US, better data coming out, GDP growth, etc. But the recent headlines around their net borrowing requirements has obviously provided quite a boost to asset markets. The Treasury's rallying quite a lot, so this has promoted stocks higher. It's sort of looking like a rosier picture, particularly with recent inflation data indicating that there's less chance of a crash landing, but it cannot be ruled out in terms of where inflation's tracking. There are some concerns over future sort of economic growth in the US, but in the meantime, dollar's doing pretty well at the moment. In contrast with the euro's been dropping quite a lot. It's been sniffing around the sort of 107 handle, dropping from the recent highs of like 110, 111. GDP growth is questionable again in the euro, across the euro region. There's still a lot of confusion about what's going to happen with the ECB. The markets continue to be pricing in a slightly different monetary policy strategy than what the likes of Lagarde and the ECB are sort of indicating over the next 12 months. So the upcoming ECB meetings will be pretty interesting. The last one that just went past was almost a non-event, which probably caused a bit of disappointment to the markets, but we'll see what happens going forward. Over in emerging markets, as we look at the frontier, Nigeria is, again, as always, one of our big focuses, but I mean, all of our markets have had a lot of movement recently. The parallel market is literally today just broken through sort of 1500 levels, which are unprecedented new highs for the rate. A lot of questions over what's been going on because the CBN have been announcing various injections of liquidity of dollars into local banking institutions to get rid of their FX obligations. Another $500 million was announced this week. There's still quite a lot outstanding, but I mean that's sort of $2.5 billion that have been cleared over the last sort of 30 days. However, it seems to have had no impact in the market. The first announcement around these obligations being removed, we saw a lot of positivity in the rate. The rate dropped quite a touch down to those sort of 1,000 levels about 2 to 3 months ago, but it seems like the firepower behind those headlines is definitely waned quite a lot. Looking at inflation data in Nigeria as well, it's quite concerning around money supply data that's been coming out. A lot of liquidity in the market. It seems that these open market operations perhaps aren't having the effect that perhaps the CBN wanted. It's clear that there's a lot of big multinationals managing to liquidate their balances, so maybe that's appearing in M2 data, but there is some cause for concern. Now, there were a lot of OMO auctions in January. When this data starts to hit, maybe it might have a positive impact on inflation, but from now until the end of February, when we have the next monetary policy meeting in Nigeria, we could see a lot more weakness. The market's already pricing in 5% hikes, there or thereabouts. So it's a little bit concerning that the parallel rate continues to slide even in that potential monetary policy tightening environment. Over in Kenya, it's been very interesting. We kind of felt in Nigeria the depreciation had the potential to pull back on a CBN or government announcement of some sort. However, in Kenya, the sort of solutions towards depreciation were sort of few and far between. With the upcoming Eurobond payment, there's clearly a lot of concern in the market that it won't get paid. There's various sort of like deals have been done with the IMF, but we question whether those funds can actually be used to clear debt obligations. It's not something the IMF particularly likes. So that Eurobond repayment in June is looking, well, shaky at best, but I'm sure they'll get through it. However, this has lost a lot of confidence. We saw the Kenyan shilling rate go up to around sort of 166, 167 levels, but then literally this week, it seems like local institutions have really been tightened on what levels they can trade dollars at or sell dollars at. So that's actually caused quite a sharp appreciation this week in the market. We're now sort of seeing the 163 levels again, still a lot higher than where we were 6 months ago, but I mean, it's great to see some appreciation in the market. Yes, it's a bit hook by crook by sort of restricting what the banks are allowed to do, what currency they're allowed to trade, but it's a positive nonetheless. Finally, Tanzanian shilling. Again, we're seeing this slide in depreciation a little bit. The market seems to be fairly flooded with Tanzanian shilling at the moment. It doesn't really seem to be anything macro that's driving it particularly. Data continues to be pretty good. Inflation's in check compared to a lot of other African countries in the Eastern Corridor, but also in the West. But what we're expecting to see is depreciation slow down a little bit, but we'll see what happens over the next couple of weeks. Finally, some question marks over, so I did say finally already, but this is another finally, over Central African franc. We heard that 3 of the nations who use ZOF as their currency have decided to pull out of the sort of economic union, but it's not the monetary union per se. So there's some question marks over whether the likes of Mali, Nigeria will continue to use ZOF. Obviously it will be quite an extended transition. Price action doesn't seem to have changed too much for the time being, but it's definitely something to look for. If they do formally leave the economic region, we could see a departure from the monetary union. Then we'll see what happens to ZOF thereafter. ZAF, on the other hand, doesn't seem to have been affected too much, but we'll be keeping an eye on the spread between those two Central African currencies over the next month or so.